When you look at today's market, is a stock with a falling trend, a stock flashing sell signals? Is it a massive value trap? Or is it, a secretly undervalued strong buy?
That is the trillion-dollar question right now.
Here.
Literally.
Right. Well, welcome to today's deep dive. We are thrilled you're here with us because today our mission is to unpack a highly volatile stock that is honestly going through a massive identity crisis.
Oh, massive, yeah.
It's April 22nd, 2026, and we are looking at Tesla, ticker symbol TSLA.
Which is, it's the battleground stock of the year, without a doubt.
It really is. And before we jump into the raw numbers, just a quick bit of housekeeping. Please remember to like the video and subscribe to the YouTube channel.
Yes, please do.
And honestly, leaving your feedback in the comments today is compulsory. We really want to hear your take on this debate, so get down there and tell us what you think.
We definitely want to hear from you, but we also need to remind you that everything we talk about in this deep dive is strictly for educational and entertainment purposes.
Exactly. We're looking at data, we're talking market psychology, but this is not financial advice.
Definitely not financial advice.
Yeah.
Do your own research, always.
Always. So let's just get right into it. Let's look at the current snapshot. Because yesterday, the stock closed at $386.42.
Right, which was down, about 1.5%?
Yeah, down 1.5% yesterday. But you really have to zoom out and look at the 52-week range to understand the whiplash here.
The volatility is just wild.
It's insane. The low was $222.79 back in April of 2025. And then it had this dizzying high of $498.83 in December of 2025.
Right. So a massive rally, and now it's pulling back. And to understand why that's happening, why there's this identity crisis, we really need to look at the fiscal year 2025 financials.
Let's do it. Open the hood.
Okay, so total annual revenue was $94.83 billion.
Which is huge. That's a massive top line.
It is huge. But here is the number that is freaking Wall Street out. Net income was only $3.85 billion.
Ouch.
Yeah, that is a massive 46% year-over-year drop.
Wait, almost half. Their net income essentially got cut in half.
Yep, almost half of the profit just vanished. Operating cash flow was still $14.75 billion, and free cash flow was $6.2 billion. But that net income drop is severe.
What about the end of the year? Like just looking at Q4.
Q4 specifics. Revenue was $24.9 billion, but net income was less than $1 billion. It was $0.84 billion.
Wow. Okay, so wait, let me process this. If we look at their balance sheet, they have, total assets of around $137.8 billion, right?
Yeah, $137.81 billion.
Yeah.
And total debt is only $14.72 billion.
Right. And they have this fortress of cash, $44.1 billion in cash.
Exactly. It's a massive war chest.
So my analogy here is it's like they have this giant $44 billion piggy bank, right? But the main engine of the car, the net income, is just sputtering. It's down almost half. Why? Why are the margins compressing so badly?
Well, it's really two things hitting them at once. First, it's the automotive price cuts. They've been slashing vehicle prices to keep market share.
Right, which just eats directly into the profit margin per car.
Exactly. And the second thing is they are spending an absolute fortune, massively increased R&D spending for AI.
The artificial intelligence pivot.
Yeah. Building supercomputers, robotics, all of it. It's incredibly capital intensive.
Okay, so the fundamentals tell us what happened last year, right? But we need to look at the trading charts to see where the momentum is right now today.
Yeah, let's look at the technicals.
Yeah.
Because right now, the trend direction is officially classified as neutral or consolidating.
Meaning it's kind of just chopping sideways.
Exactly. It's trapped. If you look at the moving averages, it's trying to reclaim the 50-day moving average, which sits at $390.24.
Okay.
But it is firmly trapped below the critical 200-day moving average. That's at $399.25.
So it's stuck under 400, basically.
Right. And the short-term momentum is weak. The 5-day moving average is sitting at $388.26, and that is actively flashing a sell signal.
A sell signal. Wow. So what does the battlefield look like? Where is the support?
Immediate support is at $359.07.
Okay, so if it drops from 386, buyers might step in around 359.
Right. But the major psychological floor, the real line in the sand, is that 340 to 350 zone.
And what about the upside? If it tries to rally?
It's going to hit a brick wall. There is heavy Volume-weighted selling pressure acting as huge resistance right at $400.63 and again at 410.
So people are just waiting to sell if it touches 400.
Exactly. And the indicators back this up. The 14-day RSI is neutral, hovering between 45 and 60.
Okay, so it's not overbought or oversold, just kind of floating.
Yeah, floating. But the MCD, the momentum indicator, is sitting between negative 1.43 and negative 3.22.
Which is bearish.
Yeah, it's a lingering sell signal. It indicates bearish momentum under the surface.
Okay, so this brings up something I really want to ask you about, because the order flow right now is completely polarized, isn't it?
Oh, completely. It's a tug of war. Retail traders are aggressively dip buying. They see it down from nearly 500 and think it's a steal, so they're keeping the stock above its 2025 lows.
Right. But what about the institutions?
The smart money. They are highly, highly cautious. They are looking at that margin degradation we talked about, and they are the ones selling.
So I have to ask you, and I want you, the listener, to think about the psychology here too. Are retail traders stepping into a massive bear trap? Are they just blindly fighting this huge institutional selling pressure at that 400 resistance line?
It's a very real danger. When retail fights institutions, institutions usually have more capital to outlast them.
So if retail is buying the dip and institutions are selling the rally, there's obviously a fundamental disagreement on what this company is actually worth.
A massive disagreement.
Let's look at the analyst ratings. I have the Wall Street consensus right here.
Let's hear it.
Okay, so officially the consensus is a hold, but the breakdown is wild. 29% say strong buy.
Okay.
21% say buy, 32% say hold, 11% say sell, and 7% say strong sell.
See, that is a perfectly fractured market. Nobody agrees.
Right. And the average 12-month price target is $415.81, which isn't even that far from where it is now.
No, it's basically flat. And the reason nobody can agree is because of the valuation. Are you ready for the PE ratio?
Lay it on me.
The stock trades at an eye-watering price-to-earnings ratio of 359 to 365 times earnings.
360 times earnings. That is, that's just absurd.
It's shocking. And this is the core of the debate. This is the undervalued versus value trap debate right here.
Right, because if you value this as a traditional auto manufacturer, a 360 PE is a joke. It makes it dangerously overvalued, like a value trap of epic proportions.
Exactly. Legacy automakers trade at 5 to 10 times earnings?
Right. But what's the other side of the argument? The people screaming strong buy.
The undervalued argument is that looking at them as a car company is totally wrong. Proponents claim the current price doesn't price in the future of Robotaxi, right? Or the Optimus humanoid robot.
They're saying it's a structural pivot.
Yes. They are saying it's pivoting to a physical AI firm. And if you value an AI software monopoly, 360 times earnings might actually be cheap if they pull it off.
Okay, I have to push back on that. I really do. Can we really justify a 360 multiple by pointing at futuristic robots and AI when the core EV business, the thing actually making money today, is actively losing margin?
It's a very fair question.
At what point does, quote, "we are an AI company," just become a convenient excuse for a struggling auto business?
Well, that right there is the bear case in a nutshell. And the bears have a lot of data to back up that skepticism.
Yeah. Let's unpack the downside risks. Let's look at the bear case.
Okay, so automotive revenue, specifically, is down 11% year over year.
Down 11%. Wow.
And capital efficiency is dropping. Return on capital ROC has plummeted from 10.6% down to 5.9%.
So they are getting a much worse return on the money they invest into their own business.
Exactly. And even worse, there's a really troubling gap growing between the number of vehicles they're producing and the number they're actually delivering to customers.
Oh, so cars are just sitting on lots, inventory's building up.
Yes. And the immediate downside risks are intensifying. You have massive EV competition in the APAC region, the Asia-Pacific market. Chinese automakers are just eating market share over there.
Because they're producing great EVs for way less money.
Right. Plus, there is massive execution risk in AI and robotics.
Right.
They're doing capital expenditures exceeding $20 billion.
$20 billion with a B.
Yes, on supercomputers and AI. If that fails, it's a catastrophe.
Okay, so that's the bear case. It's dark, shrinking margins, rising inventory, huge risks. But let's flip it. What is the bull case? Like the best case recovery scenario?
The best case scenario is that the pivot works.
Simple as that, right?
Pretty much. If it works, High-margin AI and software recurring revenue completely replaces low-margin auto sales. You aren't selling a car once. You're taking a cut of every robotaxi ride that car does for the next decade.
Which changes the math completely. And to be fair, they do have bright spots. I know the company is seeing absolute record energy storage deployments right now.
The Megapack business is doing incredibly well, yes.
And they still maintain leading vertical integration, right?
Yeah.
They control everything from the software to the battery manufacturing.
They do. Nobody else in the auto industry has that level of control over their supply chain.
So we're weighing a $20 billion AI gamble against a bleeding EV division, which really forces us to look at the timeline.
Timeline is everything here.
When will we actually know who is right? When do the retail buyers win, or when do the institutions crush them?
Let's break it into short-term and long-term. In the short term, like the next few weeks, all eyes are firmly on the upcoming Q1 2026 earnings margin data.
People are going to be hyper-focused on those margins.
Oh yeah. If the margins look worse and that $380 support level fails, we could see a nasty falling channel break. The stock could just drop fast.
Okay, and what about the medium to long term? Months to years out?
Long-term recovery depends almost entirely on the success of the unsupervised robotaxi expansion.
Which they're currently testing, right?
Yes. Currently testing in Dallas and Houston, it has to succeed. That, plus the successful 2026 ramp-up of 6 new production lines, is the only way to justify the valuation.
So it all hinges on Texas right now?
Pretty much. If Dallas and Houston work, the AI narrative holds.
Wow. Okay, so we've seen the retail dip buyers fighting the cautious institutions. We've seen this insane 360 PE ratio justified by a massive, really risky AI gamble.
It's the ultimate high wire act.
It really is. So, listener, here's something for you to mull over today as you look at this market. If the Dallas and Houston robotaxi trials hit a regulatory wall, like if a city just says no, does the entire physical AI narrative collapse?
That is the big question.
Right. And if it collapses, does that 360 times multiple come crashing down to earth with it, dragging the stock price into the abyss?
I mean, if the AI dream dies, they are just a car company with shrinking margins.
Exactly. So let us know what you think. Drop your bull or bear case in the comments below. Thank you so much for joining us on this deep dive again. This was just an exploration of the data, not financial advice.
Thanks for listening, everyone.
Stay curious, and we'll catch you on the next deep dive.